Today we're going to talk about the 2 fatal flaws when it comes to investing in retirement. The 2 fatal flaws that can be just absolute kryptonite when it comes to your investment strategy in retirement. So rule number 1 that we want to talk about here, it plays to Peter Lynch's top rule to investing, and it's simply don't get scared out of stocks. It's really important to understand that, hey, we have a long time horizon, and this will play into rule number 2, but understanding that reacting emotively to the randomness of equity returns can be absolute kryptonite to your long-term investment strategy. So when we think about years like 2022 and what actually happened to both stocks and bonds in 2022, we roll into 2023 and everybody got it wrong, right? We look at the top Wall Street strategists and most thought it was going to be a terrible year in stocks. And it was just another reminder to myself as a professional in this industry for darn near 20 years that in order to get the returns and adequate returns that you need over time, getting in and out of the market and trying to time that is just unattainable. So staying in stocks, not acting emotively and dropping in and out of stocks is one massive key to success. Rule number 2 that I'd like to talk about simply is the amount of folks that, and the thousands of retirement plans that I've done over time, people grossly underestimating the potential longevity or how long they will live in retirement. So we can look at all the statistical data in general, but what we generally see is folks thinking that they're going to die when they're 65, 70, 75, therefore I shouldn't be in the stock market. It's just, we just see that happen all the time. I have many clients happily in their mid-80s, early 80s that seem to be quite healthy that thought, hey, I'm living a decade longer than I thought I was going to live. And so it's been vitally important to them to maintain that exposure to stocks, to give them the amount of time for the compounding interest to offset the effects of really the rising costs of goods. And so to prove this to you, what I really want to do is put a chart on the screen here. We can walk through what this means and why I have such a high conviction, as well as our entire firm, just around the outperformance of stocks when it comes to core inflation, since this is such a big topic of conversation, and why the Fed, quite frankly, has had to raise rates more times than we've seen back in 2022. So let's take a look. This is a Nick Murray annual updated chart. So I want to give all the credit to Nick Murray here, but he's asked a lot of really important things. And so what he wanted to do is go back to 1962. Since 1962 until the end of 2023, this chart is updated. The S&P 500, if you take a look at the amount of times it's compounded, has gone up 76 times since 1962. Incredible stat there. Let's take a look at the dividend. The dividend alone, if you're just taking the dividend or looking at the dividend from the S&P 500, it's gone up 33 times what it actually was in 1962. And then compare both of those against what core inflation is, or CPI. That's really the read that a lot of people use to gauge inflation. But the CPI has gone up 10 times that of what it was in 1962. When we really think through the statistical data of the S&P, the 500 most important companies, one could argue, in the world, those dividends that are produced by those 500 companies, and then core inflation, I mean, I have yet to see a better inflation hedge than the companies that, quite frankly, are there raising prices on us during a rising inflationary environment. So again, just statistically speaking, wonderful passive investment. You just have to stay in the game long enough to realize the growth over time. And going back to Peter Lynch's rule of not getting scared out of stocks so that you can actually realize the full gains that the stock market can actually give you. So in conclusion, I've got kind of 3 takeaways personally as I sit through and look at these different things. One is, I mean, I just have yet to see a better passive investment that's such a wonderful inflation hedge. So I've been telling clients a lot recently as this conversation of inflation comes up is, hey, if companies are going to raise prices on you like we've all seen over the past couple of years, you might want to own that company as a shareholder that's actually raising prices on you. Number 2, when it comes to the randomness of equity returns, based upon last year, nobody knows anything. And that's a humbling thing to say as an advisor, a person in this industry, again, of 20 years. all the stock traders on Wall Street, a lot of the economists thought that last year was going to be a horrendous year in the market. And look what happens. We had an absolute blowout year for stocks if you stayed the course. So again, it's not about timing the market, it's about time in the market, and don't interrupt the compounding, as Charlie Munger also says. And third, it's about maintaining adequate exposure to said stocks that we've been talking about this whole time, and having a holistic investment strategy for retirement that's anchored in not just your core beliefs and who you are, it's kind of defining your why you're investing in the first place. So that's the emotive piece, the emotional piece, but have that backed up with a statistical plan, data. You all have seen those retirement plans that we've done with you over and over and over. So it's not just about the guttural belief in what the market can do, but it's also creating you as the benchmark in the long-term financial plan that we're creating for each one of our clients. And if you have those two things, I think it will help you stay the course in understanding not just how much exposure you should have to stocks, but staying in that investment strategy when we get bad news on Wall Street or if we see the stock market go down momentarily, because that's all it is. At the end of the day, stocks go up over time. Hope this helps.